Hello, and welcome to Bite Size Legal, where we tackle legal issues one bite at a time. My name is Drew Jenkins, and I'm an attorney licensed in Georgia and Alabama. And today, we're going to take a quick bite out of like-kind exchanges, also called a Section 1031 exchange. We began this series by talking about depreciation, essentially that the IRS recognizes the value of improvements to real property are going to decline over time, and thus you will take taxable losses over the years. Last week I warned you that those losses are going to need to be recouped at some point by the government in what's called depreciation recapture. And today I'm going to tell you how you can delay the payment of both sets of those taxes, or in their parlance, to defer them until some point in the future. So Section 1031 of the tax code is the like-kind exchange provision. It says that if you transfer one property of a like kind, then we're just going to pretend that you swapped them, you traded them for each other, and there's going to be no recognition of gain or loss until you ultimately, each of the parties, sell their property. It makes sense and is easy. It was abused at its outset because there was no time limit. So the IRS has now put some rules that are pretty strict. So long as you know them ahead of time, you ought to be able to follow them. So let's walk through them one at a time. Number one is, you don't have to actually trade the land for another one. It would be kind of hard for you to find another party who wants your property and you want their property and you both agree to trade for it. The IRS recognizes this, and that's why there are entities called qualified intermediaries, or QIs, that exist. They allow you to sell your property to an unrelated third party, right? And then the funds do not go to you. They go to the qualified intermediary, and they will hold the money in trust for you until you close on your replacement property that you're buying from someone who also is not involved with your 1031 exchange. Now, you don't get to hold the money forever. Even though in the first case they were able to hold it for 5 years, you now have 180 days from the date of sale to close your replacement transaction. And you only have 45 days from the date of sale to identify your replacement property or properties. So this is important. If you're doing a 1031 exchange on the date of sale, the money will not go to you. The money will go to your qualified intermediary. It also begins a clock that you have 45 days to identify your replacement property or properties. And from that date of sale, you have 180 days to close it. If for some reason you fail to close or you fail to properly identify your properties, your 1031 fails, and you will owe taxes as though the qualified intermediary had never received the funds. So this is actually pretty important. Now, there are strategies you can use if for some reason you're having difficulty. You can use advanced strategies like a Delaware statutory trust in order to get what you need. Now, the next thing that you need to understand is that you have boot. Now, boot is the amount of money that you receive outside of the sale. So, for example, if your replacement property is going to cost less than the property that you sold, it's not going to actually blow up your entire 1031 exchange. What it's going to do is you will cap out at the value of the 1031 exchange. So let's say that you have a property for $180,000 is what you have received at sale, and for whatever reason the property that you've identified and you're closing on is only costing $150,000. So at the end of the total transaction, you're going to receive $30,000 in cash. That's called your boot. And your boot is going to be taxable. Now, how is it going to be taxable? It's going to be, some portion of it is going to be long-term capital gains. Some portion of it may be depreciation recapture. You need to talk to your accountant to figure out exactly how you're going to structure that boot coming in. Now, another thing that you need to be aware of is that if you sell property and you didn't pay off the mortgage, this is a lot more common with commercial property, your buyer agrees to assume the mortgage, do not forget that debt forgiveness is considered income. So it's not the value of cash that you received for 1031 tax purposes. It's also going to be the value of the mortgage that was forgiven to you, that now your buyer is responsible for. And if you're the buyer of property, it's the same thing, right? If you are assuming your seller's mortgage, then your purchase price is not what you're paying for it. It's what you're paying for it plus the value of whatever the mortgage is coming in. This is why when it comes to real estate transactions, I always strongly recommend that you involve your CPA to help you navigate exactly what the tax consequences are going to be to you. So in short, Section 1031 is a delaying mechanism. It does not get rid of your taxes. They will still be owed at some point, right? If you do engage in a 1031, you don't have to trade or swap the land with your seller. You will use a qualified intermediary. That then begins a clock, 45 days to identify your replacement property, 180 days to actually close on it, and any amount of money that you receive as part of this. If for some reason part of it was sent to your bank account, or at the end of the transaction there's still money left over, that's called boot, and that boot is going to be taxable. So I hope you found this useful and informative. If you're watching this on YouTube, please leave me a comment below. If you're watching this on WeChat, you can respond in the thread, and I will see you next week.